Okay, let's unpack this. We're diving into something pretty strange happening right now in the financial world, a real contradiction. If you've been watching the markets, you know things have felt, well, heavy. Bitcoin took a hit recently, dipped almost 2%, slipping back towards that big $100,000 psychological mark. And it wasn't alone, right? It dragged down major stock indices like the S&P 500 too.
hmm
That's the fear playing out.
hmm And then here's the kicker. Right when that fear was maybe peaking, one of the biggest banks out there, JPMorgan, drops this report. And they're basically shouting from the rooftops that Bitcoin isn't just cheap, it's like dramatically undervalued.
Wild. So that's our mission for this deep dive. We've got these sources painting two totally different pictures. On one side, you have the short-term panic, driven by macro worries, maybe pulling Bitcoin down. And on the other, this long-term institutional view from a huge bank, no less, seeing this massive $68,000 discount. We need to pick apart this clash, help you sort through let's say, the market noise versus the potential structural signals.
Yeah, and this isn't just your standard crypto volatility story. It feels different. It's like institutional fear clashing directly with institutional conviction. Because that dip, it wasn't just Bitcoin acting weirdly on its own. It kicked off with some real anxiety about the U.S. economy itself.
Okay, let's start there then, with the fear. What specific economic news got Wall Street and crypto markets so spooked at the same time?
Well, it really boiled down to two main signs that the economic engine might be sputtering a bit. The first one, and honestly pretty alarming, was about jobs. We got this report, unofficial but closely watched, from Challenger, Gray, and Christmas. And it showed companies confirmed, get this, over 153,000 job cuts just in October.
Wow, 153,000. That's a huge number for 1 month. You said highest October since 2003.
Exactly. And the timing made it even more impactful. Why did this unofficial report suddenly matter so much? Well, remember, the U.S. government was in that temporary shutdown period, so the official job numbers were delayed. And in that kind of information vacuum, this Challenger report, it basically became the only game in town for traders trying to gauge the economy.
Yeah.
It confirmed their fears.
So when Andy Challenger himself says the pace of job cuts is much higher than average, investors just react. They pull back.
Instantly. So that's point one, accelerating job losses. And then you couple that with the second signal we saw in the sources, these reports showing household debt just surging.
Okay, so job cuts plus rising debt. That sounds like a recipe for consumers to tighten their belts. How does that connect directly to, say, Bitcoin's price?
It's a pretty direct mechanism, actually. Think of the whole investment world like needing fuel, right?
Yeah.
Discretionary money. When household debt goes up, people have to use more income just to pay off loans, credit cards, whatever. Add job losses on top of that. People immediately slam the brakes on non-essential spending. Less travel, fewer big purchases, and crucially for us, they stop putting money into or even sell off riskier assets.
Like crypto.
Like crypto, yeah. Bitcoin often being exhibit A for volatile, risky assets. The whole machine just gets starved of that extra cash.
Okay, so the economic engine is low on fuel, and when that happens, everyone turns their eyes to
The Federal Reserve,
Okay.
the Fed, the ones with the gas pedal and the brake for the economy, using interest rates.
Right. We've been in this high-rate environment for a while, the Fed hitting the brakes to fight inflation. But this bad news, the jobs and debt, suggests maybe they need to ease off, maybe even hit the gas.
That's the expectation. If the economy looks like it's sliding towards a recession because people are losing jobs and drowning in debt, the standard playbook says the Fed should cut rates, make borrowing cheaper, stimulate things again.
And here's where the market reaction got weird, wasn't it? Some investors actually saw this bad economic news and cheered initially.
Sounds completely backwards, but yeah. They thought, okay, the economy is weak. This forces the Fed to cut rates soon.
Like, oh good, the engine's sputtering. Maybe they'll finally give it some gas.
Exactly. And you could measure that optimism. Sources like the Kobisi letter were saying this weakness meant the Fed would have to cut rates more, leading to easing financial conditions. We even saw the CME Group's FedWatch tool that tracked market predictions, showing, at the time, a 69% chance of a quarter-point rate cut in December.
69% probability. That's pretty high conviction for cheaper money, which should boost assets like Bitcoin. So what went wrong? Why the dip?
Well, enter the counter-argument. QCP Capital, another source we looked at, poured some cold water on that. They basically warned, hang on, the market is acting like this rate cut is a done deal, but what if the Fed just pauses?
Just does nothing. But if the economy is showing signs of weakness, why wouldn't they cut? Wouldn't pausing just sort of lock in the economic pain?
It could, yeah. But the Fed's job is complicated. Maybe they worry cutting too soon could spark inflation again. Or maybe they just wanted to wait for those delayed official government job numbers before making a move. Whatever the reason, if the Fed pauses when everyone expects a cut, the US dollar usually strengthens a lot.
And a strong dollar is bad news for Bitcoin.
Right. It acts like this big vacuum cleaner, sucking money out of anything seen as risky, including Bitcoin, and pulling it back into the perceived safety of the dollar.
Okay, so that sets up this huge tension. The market hoping for rate cuts versus the fear that the Fed just holds steady, strengthening the dollar.
That's the macro picture in a nutshell. Huge uncertainty.
Got it. So, bad economic signs, Fed uncertainty. That explains the external pressure. But then QCP Capital also mentioned internal factors needed for Bitcoin to bounce back. They specifically said Bitcoin needed strong institutional buying, right? The whales needed to show up.
They did. That was their condition for a sustained recovery. But what actually happened?
The exact opposite. We looked at the spot Bitcoin ETFs. These are supposed to be the easy, regulated on-ramps for big traditional finance players, right? The sturdy bridges into crypto.
They should be, yes.
Yeah.
Reflecting institutional confidence, ideally.
But the data showed almost $900 million flowing out of these ETFs in just the first 3 days of that week.
900 million out. That's not a small change. That's a pretty significant signal of institutional, well, hesitancy at the very least. A stampede for the exits, maybe.
Yeah, when the big money gets nervous and starts pulling back like that, it really shifts the focus onto the technical levels, doesn't it?
Absolutely. All eyes immediately go to the charts.
And the big number everyone was watching, and still is that $100,000 mark. Kind of a psychological line in the sand.
Definitely. If you lose a big round number like that, it can trigger more automated selling, more panic. But the technicals also pointed to a specific risk below $100K.
Okay, this is where we get into the CME gap, right? Can you explain that for listeners? What is that, and why does it matter?
Sure. So the CME group runs a major exchange where Bitcoin futures contracts trade, mostly used by institutional players. Now, unlike Bitcoin itself, which trades 247, the CME futures market closes over the weekend.
Okay.
So sometimes the market might close on Friday at one price, and then because Bitcoin kept moving over the weekend, it opens again Sunday evening at a significantly different price, higher or lower. That jump, that price range that was skipped, that creates a gap on the futures chart.
And why do traders care about these gaps?
Well, there's this theory, especially popular among technical traders who watch institutional flows, that the market doesn't like these gaps. They feel unnatural. The belief is that the price often feels this kind of gravitational pull to return and fill that gap, meaning trade within that price range that was initially skipped.
Okay, so it's like unfinished business on the chart that the price feels compelled to revisit.
Sort of, yeah. That's the thinking.
So if Bitcoin breaks below that $100,000 psychological floor, where does this CME gap theory suggest the price might be pulled towards?
The sources were really specific on this. The next major unfilled CME gap that traders were eyeing sits right around the $92,000 level.
$92,000. Oof.
Yeah. So you had this convergence, you had the macro anxiety, you had institutions pulling money out via ETFs, and then you had this technical analysis pointing down towards 92K. It painted a really grim short-term picture.
Okay, this sounds like a perfect storm brewing. Everything lining up to push Bitcoin significantly lower, which makes the timing of that JPMorgan report just incredible, a complete plot twist. Right when things look darkest, JPM, led by Nicolaos Panagiotis, comes out and says, wait a minute, Bitcoin actually looks more attractive than gold right now.
It's whiplash, isn't it? You have to really pause and think about that. One of the most established, traditionally cautious banks on Wall Street is saying this super volatile digital thing is a better buy than gold, the ultimate traditional safe haven.
How do they even arrive at that conclusion, especially with Bitcoin's price falling and the $68,000 discount figure? It sounds almost too good to be true, like something you'd see on, crypto hype channels, not from JPMorgan.
It does sound dramatic, but it comes down to their specific valuation model. It's quite structured, actually. They essentially view Bitcoin as digital gold. They see it competing for the same investment dollars that traditionally flow into physical gold or gold ETFs. So their starting point is comparing Bitcoin's total value, its market cap, to the total value of gold held purely for investment purposes.
Okay, comparing it to investment gold makes sense as a foundation. But Bitcoin is way, way more volatile than gold. They must account for that, surely.
Absolutely. That's the crucial part of their model. They apply a very significant adjustment, a discount factor, specifically because Bitcoin's price swings are so much wilder than gold's.
Right. Big institutions can't just ignore that volatility risk.
Exactly. They need to be compensated for taking on that extra risk. So if Bitcoin is, say, 5 or 10 times more volatile than gold, JPMorgan's model values it substantially lower than it would if it were as stable as gold. It's
Right.
risk adjustment.
So their fair value isn't predicting tomorrow's price. It's more like what Bitcoin should be worth in a big, diversified institutional portfolio once you properly account for its crazy volatility compared to gold.
You've got it. It's a theoretical value based on its role as digital gold,
Yeah.
adjusted for its real-world risk profile.
Okay, and what makes the current finding so striking is the history here. We remember reading that late last year, JPM used this same model and concluded Bitcoin was actually overvalued.
That's right, by about $36,000 according to their model back then. They were saying it was too expensive relative to gold considering the volatility.
But now, after this recent price drop brought Bitcoin down near $100.
Their math completely flipped.
Right.
Now, the same model concludes Bitcoin is undervalued by about $68,000 compared to that volatility-adjusted fair value relative to gold.
Wow. Okay, let's make sure everyone listening gets this crystal clear. JPM isn't saying the price target is $168,000 tomorrow. They're saying, based on their long-term structural comparison to gold, adjusted for risk, the current price around $100 is sitting at a massive $68,000 discount to where their model suggests it should logically trade.
Precisely. It's a statement about fundamental structural value being disconnected from the current market price, which is driven by all that short-term fear we discussed.
So we've got these two powerful forces pulling in opposite directions. You have the short-term noise, the economic fear, the ETF outflows, that technical gravity pulling towards $92,000.
The noise.
And then you have this potential long-term signal. A major institution like JPMorgan saying, fundamentally, structurally, Bitcoin is incredibly cheap right now, a fire sale price almost.
That's the conflict, the short-term panic versus the long-term structural argument.
So the big question then is, how do you, as someone trying to understand this market, make sense of this? How do you process the pull towards 92K and the 68K discount idea at the same time?
That's the challenge. I think the first step, the most critical insight really, is learning to distinguish between that short-term noise and the potential long-term signal. So the daily ETF flows, the second guessing of the Fed's next meeting, whether that CME gap fills tomorrow or next week, that's mostly noise. It drives short-term price action for sure, but it might not reflect the underlying value proposition.
And the signal?
The signal, arguably, is that major, serious institutions like JPMorgan are dedicating resources to building these kinds of persistent, complex valuation models. The very act of comparing Bitcoin to gold structurally, year after year, even if the conclusion changes, that's the signal. It shows a growing acceptance of Bitcoin as a legitimate asset class worthy of serious analysis.
That's a great way to frame it. The $900 million ETF outflow seems less significant when viewed against a bank basically saying, we now have a formal framework for valuing this thing alongside gold. Okay, what's insight number 2?
Know yourself. You have to honestly assess your own tolerance for risk and volatility. We saw how a single jobs report could knock 2% off Bitcoin's price. You need to ask yourself, if the bears win the short-term battle and the price does dip to that $92,000 level they're talking about, can I stomach that? Can I hold through that without hitting the panic button?
Because if you sell at 92Ks out of fear, you're reacting purely to the noise, not the potential long-term signal JPM is highlighting.
Exactly.
Yeah.
You'd be letting the short-term fear dictate your long-term position.
Okay, third point.
Diversification. It seems obvious, but this episode really hammered it home. Look how Bitcoin moved pretty much in lockstep with the S&P 500 when that macro fear hit. It shows that while Bitcoin might be digital gold in theory, in moments of broad market stress, it can still behave like any other risk asset. Stocks, tech, crypto, they can all suffer together. So don't put all your eggs in one basket.
Sound advice. And the final takeaway.
You need a clear thesis. Why are you interested in Bitcoin? What's your reason for engaging with this asset? Are you trying to trade the short-term swings, playing the Fed guessing game and watching those technical levels like the 92K gap? Fine, but that's one strategy. Or do you fundamentally believe in that longer-term digital gold narrative? Do you agree with the core idea behind JPMorgan's model, even if you debate the exact numbers?
And if you hold that longer-term view,
Then these dips, driven by short-term noise, might actually look like opportunities. That potential $92,000 level shifts from being a disaster to potentially being, well, a gift, a chance to buy at that deep discount JPM identified. Your thesis dictates how you see the current price action.
This has really laid out the conflict zone perfectly. You've got the raw fear represented by that 92K CME gap versus the calculated institutional confidence embedded in that 68K discount model from JPM, a real tug of war.
It really is.
Yeah.
And it shows how the market can be incredibly fearful in the immediate term, even while some of the biggest players are quietly building the analytical foundation for why they might hold this asset for the next decade.
Okay, so let's leave our listeners with something to really chew on. A final provocative thought. The question maybe isn't just whether Bitcoin hits $92,000 next week or bounces back above $100,000. The deeper challenge, I think, is deciding whether this surprising $68,000 discount calculated by a bank like JPMorgan fundamentally resets your own long-term perspective on Bitcoin's future. Does their analysis change how you view its potential role in the global financial system, regardless of today's headlines or tomorrow's price swings? Is it just a volatile tech play, or is it genuinely becoming something more structural, something undervalued?
That's the core question to grapple with.
Define your thesis, and then see if you have the conviction to stick with it.